Hey guys, in this video I'm going to cover another issue with moving your money around in your TSP account. This is going to cover the fallacy of moving money based on market trends. I'm going to show you information on basically the IFT activity of a particular TSP oriented website and analyze what they basically give you a good comparison of what my own activity looks like versus what theirs looks like. Also, what did the website do, and what kind of results did it get, and what did I do, and what kind of results did I get from my moves? Okay, and also I'm going to talk about IFT transaction histories and more analyze, looking at more finer details of each of those between myself and the particular TSP related website. I'm not going to name the site, but I'm sure some of you guys will figure out. If you have experience with this particular site, you might recognize who it is. But please don't. Let's not discuss who it actually is. I'm not here to put them down or anything. I'm not. I don't want to give them necessarily um, needless attention that they don't really deserve. Based on what you see here, you're going to see why I don't recommend following them. But anyway, I'll give you a good explanation of what went on with each move that was made by that site and what the end result was, and as well as show you what my moves were and what was good or bad about each, well, whether it was theirs or mine. Okay, let's move on. Let's start with just a basic side-by-side comparison, or I should call it top and bottom comparison of the TSP particular website and my own IFT history. Okay, the top section here is the information on what this particular TSP related website did over the last 2 years, basically since the end of 2017 to today's date, or actually May 13, which was yesterday. The markets are still open right now, so we don't have prices to work with today. So the most recent prices are the ones you see for May 13. As you see, there was a pretty fair amount of IFT activity from this site. Let's see what they had. They had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Had 18 interfund transfers in all between the beginning of 2018 and yesterday. Or more specifically, their most recent transaction appears to have been February 11 of this year. Okay, so end result here, this is what we're looking for. Now, I'll get a little more into the details of what exactly all these columns mean in a bit, but the bottom line, what we're trying to get from this particular view is right here. So in 2 years' time, all these interfund transfers they did, all they have to show for it is a minus 5.85% showing. So in other words, if they had an original balance of $10,000 in the account, that $10,000 would only be worth $9,415.42 today. Not very good, especially, I mean, I could show you a chart of the stock funds, but I don't. It's unnecessary because there is a slide here later that'll show you what kind of returns the TSP stock funds got in 2018. Also, 2019, we already know for a fact that the stock funds, or the CNS funds in particular, are both up more than 10% so far this year. Even with the recent drop, they're still up by double digits. So that's more reason to really question the performance of this particular website. The bottom part of this shows what my IFT history has been like over the last 2 years. As you see, it's not very much. I normally will do a lot more moving around on a typical year, but again, I will not move if I don't think that prices are where I want them to be before I'll move, or if I don't think that there's enough volatility to work with. So keep that in mind. But what you will see here, though, is over that 2-year period, or 1.5 year, I should say, between December 1st, 2017 and yesterday, I am currently up 6.41%. Now keep in mind that does include that does factor in the fact that the S fund, which is where I'm currently currently have 100% of my money, is actually down about 7% just in the last week from where it was just recently. So that could really be up more. I could really be up double digits from my end of 2017 figures, if that's considered. Now let's move on to the details of this TSP related website's transactions. I want to give you a little more perspective on. Okay, they made all these different moves, and you see this is basically G, F, C, S, and I funds. And I'll go into a little more detail on what the end result of each was and why everything they're doing is completely backwards from what they should be thinking. And you'll see a massive difference between the way they think and move and the way I think and move. Okay, so looking at their specific IFT history, basically just give you kind of a rundown on what's going on with each of these columns. This is the GFCS and I funds from left to right. These are the share prices that each of those was at on that particular date you see here. And I started with just a theoretical balance of $10,000 because I like to work with 10,000 or 100,000 because it's easy to figure out what that money itself, the original amount there, is actually doing performance-wise over the course of time. Okay, and the yellow cells here, that's basically how much of this amount here is divvied up into each of the particular funds. Again, GFCS and I from left to right. Again, GFCS and I here this is basically how many shares are owned at that particular dollar amount and that particular share price. So you see here, this site had $5,000 in the C fund, and then another $5,000 in the I fund at the end of 2017. Based on the end of 2017 share prices, it would have came out to 132.94 shares of C fund and 162.05 shares of I fund. Okay, so on the next row here, they made a move on January 30, 2018 to 60G, 20C, and 20I. So basically, they moved a little more than half of their money out of the C and I funds that they were already into the G fund. Now, here's this one actually wasn't such a bad move necessarily, but I'll get to that in a second here. I want to explain a little bit more on this here. Okay, so this 10,544.75 amount is basically the results of these shares here multiplied by the share prices on the date of the IFT. So when I move their money around, I got to reset the baseline price that they have, and then divvy it back up in percentages, and then get a new share count based on that. And it goes subsequently all the way down in that same manner. So ultimately, after each interfund transfer, you end up seeing the account balance will go up or down or whatever. And I think in too many cases it goes down here. Shouldn't be going down so often. Yeah, there are going to be times where it will go down, and like I say, maybe a bad move was made, or maybe it's like in today's case where I've not moved at all since last September, but share prices have dropped in more recent times, and there was a big drop throughout the fourth quarter of 2018. But we'll get to that again a little bit later here. All right, so moving on here, looking at this specific transaction, the move from 50C, 50I to 60G, 20C, and 20I. Okay, what this website did here really wasn't a bad move. The point here that I'm making is that when they did make their move, after the C and I fund prices both did climb. As you see here, on January 30, 2018, the C and I fund prices were both higher than they were on December 29, 2017, which was the end of the 2017 calendar year. So that in and of itself isn't a bad thing. They got basically a positive return on their investment before they sidelined or basically took profits over to the G fund to be safe. Now, on the next move though, they moved the rest of their money over to the G fund. So they went from 60G, 20C, 20I over to 100G. Basically, they took the remaining 40% that was in stocks over to the G fund. Problem is the C fund and I fund prices had both dropped by then. In fact, they're both very similar to where they were at when they first when they originally were in that fund, at least at the time of at the end of 2017. C fund price was slightly above where it was at the end of 2017, and I fund price was virtually identical, just a hair higher. So ultimately, it becomes a wash, but because of the previous move 60% into G fund while the prices were higher, they did get some gain out of it. They just didn't get as much as they could have gotten. And as you see here, if they had moved all of their money to 100% G fund back on January 30, this might have been a better set of moves, because then all of their money would have moved out at the same time, and the price would have dropped. But then moving back into stocks is something that you need to consider. What price are you getting back into stocks at relative to what price you exited those stock funds at? Okay, so moving on here, let's go to the next series of moves where they went from 100G and then increasingly more towards stocks. They got to as much as about 80% into stocks, and they put it into so their first move was 50G, 20C, 15S, and 15I. Kind of a weird, interesting, diverse mix, I should say. Not really a bad thing for a long-term position, although it's too heavily in the G fund for a long-term distribution. But again, this is not a long-term distribution. This is someone who's basically swing trading, or not necessarily swing trading per se, but they could just be scaling their risk profile based on what the markets are showing them. And they're probably using nothing but technical indicators to determine when to make these moves. I don't know the exact rhyme or reason to why they're making moves specifically, but I can tell you on the numbers what the end results are in a lot of these, whether they were good or bad moves ultimately. So moving here, going back to here, they moved back into stocks 50% after stock prices had already climbed back up above the C fund price. Now I'm gonna zero in a little bit more on the C fund here, because there's more activity related specifically to the C fund than there is in other funds. There are some areas here I'll cover. I'll talk a little bit about all funds, but I want to focus a little more specifically on the C fund with this site, because in general they all have decent correlation. Now again, this first move back to stocks, a little bit more of their money that went into stocks went into the C fund. But as you see here, the C fund price was already back above the price when they moved completely out of G. So what happened is they end up buying back fewer shares than of C fund than they had sold the previous time. I can't really give a good comparison here, just because of the fact that these aren't the same percentages they're working with. Now, this 20% is the same as that 20%, but there was another move in between and different overall percentages involved. And if you look here, the balance is different too. So, it's still 20% of the same of these balances here. So, can't make a really great comparison on that part of it there. So, don't worry too much about that. However, now looking again, they moved increasingly more from the G fund into the stock funds, and then they also moved their I fund money back over to the S fund, and then they basically went to 40-40 C and S, and then the rest stayed in G. Again, that happened after the share prices had climbed a little further up, and in both cases the prices were above the point where they went out of stocks and into 100% G fund. This is not a good series of moves, because you're basically forcing yourself to buy back fewer shares than you originally sold the first time. This is something I don't recommend doing. They're going by a risk profile, but was what I would assume. But again, ultimately, what are you getting back, and what kind of shares are you buying back versus how many you sold the first time around? That's ultimately the name of the game here if you're going to be moving at all. But uh, they're not getting that's not what's actually happening here in the vast majority of the cases with this site. Okay, I'm going to move on now on this next set of moves here when they move from 80% in stocks back down to 30% in stocks. They didn't do that move until the C fund had already dropped almost 5.5% on its price. Now, I do mention regularly that a typical price drop is only about 3 to 5% before prices recover. So, considering that, when prices have already dropped more than a normal 5%, do you really think it's a good time to be moving from 80% in stocks to 30% in stocks? My personal opinion is no, it's a very bad idea. You're more often than not going to get whipsawed when you do this. And what I mean by whipsawed is prices drop, and then as soon as they get through dropping and you make your move back to the G fund or bonds, whatever, the prices will go right back up behind with you not along for the ride. And that's basically what you see here. They made this move at the end of March or near the end of March on the 27th. They went from 20% G fund to 70% G fund. And like I said, the price dropped 5.47%. And the very next move they made was in a little bit the later part of April, April 19. Not even a month later, they put 30% of their G fund money back into the stock funds. But as you see, the stock prices were back up. C funds prices back up above the price where they reduced their exposure. Back S fund is actually CS and I are all up higher than what they were at during the previous move. Again, this is not a good move. This is how you buy back fewer shares with the same money than you had sold the previous time around. I don't like these set of moves here. Okay, next set of moves. I say this is still part of it. Scaling all the way from 70% or 30% in stocks all the way up to 100% in stocks. Same situation here. In each of these cases, the price is getting increasingly higher the further they go. This should be thinking a complete opposite direction. Buy more, start adding to your stock fund positions as the price drops, not as it goes up. This is completely backwards from what they should be thinking, like I said. Because you can take advantage of dollar cost averaging if you're scaling your way into stocks as the price continues to drop, and then as the price goes up, you can maybe take some of your profits off to the side if you really want to play this way. Again, more often than not, the best thing to do is to just not do anything at all, though. All right, so, and this is just another example of someone who doesn't really know what they're doing, making just moves that, from my perspective, seem very random, although they might have a rhyme or reason to it, but apparently it's not a very good rhyme or reason because they're not getting good results out of it. Okay, moving on here, when they start going from, basically when they're staying 100% in stocks, they're just moving in between the stock funds. Started out as 50C, 50S, and then they went from 50C, 50I, and then they went back to 50C, 50S. What happened here? Okay. We really want to know what did the C fund, the C fund stayed the same. So let's focus on the S and I funds here. The S fund, you wanted to see that the S fund moved up in price when they moved away from it, which it actually did do. This was about right over $50 per share, up to 51. So this was probably about a 2.5% increase in price, if I had to guess. I'm not looking at the calculator, but based on a 50 and then doubling it, it's should be in the ballpark of 2.5% increase when they moved over to the I fund. And meanwhile, the I fund actually dropped in price when that happened. So this actually seemed like not such a bad move. C fund gained money and they stayed in it, and then they moved away from the fund that actually earned money, extra money, and then they moved into the fund that began to underperform. And now the question is, this could actually have been a good move if. Let's just say if the I fund begins to outperform the S fund at that point in time after July 30. Remains to be seen, but now moving on to this next line here, the August 13 date, they went back to 50C, 50S. So End result here, this was a bad set of moves because, I say, this one was originally looking like it could have been a good move, but the fact that on the next move into S fund was higher than both the previous prices, but I fund was below both of its previous prices. So they moved into an underperforming fund basically at a bad time. The S fund continued to outperform the I fund here in this situation, and they moved back into the S fund after it had proven that the S fund had continued to outperform I fund. So not a good set of moves. Okay, next section here, we're going from 50%, or actually 100% in stocks to 50% in stocks, with a couple of IFTs involving 50% in stocks. Okay, so from that 50C, 50S to 50G, 20S, and 30I. Okay, you want to see prices drop when you move away from, or actually no, moving away from stocks into G fund. You actually do want to see that the prices went up. And that actually is what happened here with the S and I funds. They both went up here. I don't know, maybe 1% or so. This might have been actually a little bit more. I fund, let me do that math on it. 30.704. That actually seems like it was not a bad move there, actually. 29.7673. That would be a 3.15% increase in price. So that's actually good. Probably just a little bit less than that in performance on the S fund. So not necessarily. Well, then again, they moved into I fund, so it had already outperformed S by the time they did it. So now it becomes more questionable. Was it really such a good move? And then the next move, they moved basically all of their S and I fund money over to the C fund. Okay, I'd have to look more at the specifics of like how each of these two funds performed during that time and what did the C fund drop. All three of them dropped. So without actually running calculations that I'm not going to waste my time looking at, I don't really have a great way to pinpoint whether this was actually a good move here for the 50G, 50C at the time. So let's just move on. The next set, going back from 50% stocks up to 80% stocks and then back to 100% stocks. So working our way back toward the stock funds. Again, you should ideally be seeing the share prices drop when this is going on, not increase. As you see here, it actually was not, it wasn't a, first one was looked like it was kind of flat. It was, C fund was slightly up. S fund is ever so slightly up, but I fund was actually down. But I fund wasn't involved in this move, so it's irrelevant. So as you see, this maybe not such a good move to move away from stocks after the price is already up, but that's not necessarily the case. It's ultimately more about when did you move away from stocks and what level did you move back into stocks at relative to when you left stocks. All right, so but moving on here, when they went from 80% stocks to 100% stocks, there actually was a price drop there for them to work with, and this was December 4, 2018. So that actually was probably a good move there. There was only 20% of their money to move, so basically only whatever percent drop this was, what they actually experienced was only about 20% of that drop before they moved in, and only 20% of the effect, basically, or 1/5 the amount. All right, moving on. Going from 100% in stocks to 100% in bonds, or G fund. Okay, again, you want to see prices go up on stock funds when you make this kind of move, not down. However, look at this. The stock prices all dropped a pretty good amount during that time, from December 4 to December 24. They lost a lot of money here on this move. How much actually dropped? C fund fell 12.83% in its value before they bothered to make this move. This is not good. You don't know how deep these drops are going to be before stock prices rebound. economically, we were looking fine at the time. So there was no real good reason, at least based on the way I look at the markets and or actually the economy and corporate earnings. There was nothing there to support this kind of a drop. So this is just a completely uh, uh, brainless, brain dead way to invest. To be honest with you, I'm not trying to be blunt and say that they're a brain dead investor, but very, very bad decision making here. And this could just as well be the effects of an emotional decision. You can have a very intelligent investor knowing exactly what they're doing, but once you get emotions involved, and then the fear actually takes over and causes the person to make stupid decisions instead of decisions that they otherwise would know would be dumb and not be willing to make otherwise. So this is one of the downfalls of watching your account balance too much and worrying about how much money you're losing. You should be focused more on how many more shares you can buy back if you're going to move at all. Again, so bad move here. How much more did the C fund fall, or what did they get out of the next move? It didn't go well because, like I said here, they went from 100% in bonds, 0% in stocks, back to 50% in stocks, and it went specifically the S&I funds. After the S&I fund prices have already climbed back up a pretty fair amount. Let's look at this: 46,2,188 divided by 41,1846. Okay, the S fund was back up another 12.22% from his previous exit price before he got back in. Again, this is not a good, smart way to invest. Move towards stocks when stock prices are falling, and move away from stocks when they're climbing if you're going to play this active movement kind of game. In just about every case you're seeing here so far, this individual is going completely opposite that. They're moving away from stocks as stock prices fall, and then they move towards stocks when they are on their way back up already. They're missing out on some of the biggest gains that they might possibly be able to get in some of these cases. All right, let's move on to let's look at the 2019 40 to 60 C and S. Again, well, they were already 100% in stocks, but they just rebalanced. Again, prices were up higher. Can't really gauge without knowing what really was going on with each of these funds. So you would ideally wanted to see iFund outperform the others, since iFund is what he moved away from, and ideally want to see C Fund have underperformed both S and I at the time when this move toward 40C, 40S was made. Because when C Fund is the underperformer and you move towards C, you're basically saying you think that C Fund is going to become the outperformer over the next period of time. Let's move on to my IFT history, though. As again, you see here, I have plus 6.41% return over that same time frame, or approximately same time frame. You don't see any negative returns on mine. In fact, you see double-digit returns on mine prior to this year. And actually, I was in the same ballpark, the same 13-ish, more likely percent, just a week ago. Just this recent drop is what put me back down to 6.5%. But I'm still in the positive, and more importantly, how am I comparing right now to the stock funds themselves? That's the other important thing here. If you're not going to compare your own performance against the stock funds, if you're going to play any kind of a swinging kind of game like this, then you're not doing yourself any good. All right, so looking at my first IFT here, I went 100% stocks to 100% bonds, 40C, 40S over to 100% G fund on June 7 of last year. As you see, the price actually went up on both of these funds by the time I made that move. This is good. I ended up making almost $750 for every $10,000 in the account, or basically about a 7.5% gain in value just from that one move. And then my next move went from 100% G fund back to 100% in stocks, split 25-75 CNS. Now, looking at these, when I did make this move, the CNS fund prices were lower than they were when I left them. And what does this mean? I had slightly more money in my account to buy back in with because the G fund always goes up. And on top of that, because I had a little bit more money and a lower share price to buy in at, I got more shares out of it. Because these are different distributions, this is 40-60%, and this is 25-75. It's hard to really gauge this. If I'm only just swinging in and out with just one fund only, let's say I'm only swinging in and out between G and S, 100% S fund and 100% to G fund, you would have noticed this a lot more easily. But this is enough proof right here. Yeah, I did gain a little bit of money there, and then add in the fact that the CNS fund prices were lower, even a small amount below the price I exited them at. This is a good set of moves, okay? So I bought back in more shares than I had previously sold at that same distribution. All right, moving on now. When I moved from 100% stocks back to 100% G on August 24 of last year, same situation here. I waited for share prices to go up. And once the share prices went up and I thought they were at a reasonable top, that's when I went out to the G fund. Okay, so I got money out of it. So as you see here, I went from 10,765 out of every 10,000 over to over 11,338, over $11,300 on when I swung out. So, and that got me up to over 13% performance. And what's that? Just about 9 months, 8 or 9 months. So that's not bad. Okay, so that was a good set of moves. Again, this is, I mean, I'm not moving unless I get share price gains first. And then when I'm waiting for share prices to be up at or near top before I make this my next move away from stocks. And then the next move here, I went from 100G to 100S. And 100S is today where I'm still as of this date here, September 24. Okay, as you see here again, the price dropped on when I made the move. So I was able to buy back more S fund shares than I would have sold if I was 100% S fund prior to the move to G fund. I also had more money because remember, the G fund always goes up, it never goes down. It goes very slowly, but it does go up. So even a small increase in value plus any kind of drop at all in the share price of the stock fund or funds that I want to buy back into means more shares owned. More shares owned, that means more value when the price does go back up. It means the value of my account goes up proportionally faster as well as I have more shares. So say if you have $10 a share and you have $10 entry price, let's say the price goes up to 20, then you basically went up from a value of $100 to $200. But if I have 200 shares instead of 100 shares, and I do the same thing from $100 to 200, what happens then? It's gone up from 200 to 400. So it's by the same percentage, but the dollar amount is twice as much, on that next move, because I have more shares to work with now. So this is part of the importance of taking advantage, understanding compounding interest and how to really take advantage of it. Even though this video is not specifically about compounding interest, it goes very much hand in hand with this. The more you understand compounding interest and more so about how for the same pair of share prices, the more shares you have, the more quickly your account balance will go back up on the way back up. So don't worry about these share price drops. Share price drops is usually an opportunity to get more shares, not to sell them. Okay, let's move on now. I want to show you what the TSP fund returns have been like over the last 10 years. You can get this right on the TSP website. What I usually just do is on the TSP homepage. You don't even have to log in. Just go to I didn't show it, but there's a link there kind of toward the center on the left side a little bit. That'll say share price history. Just hit that and that'll take you to the share price history tab. But when you get there, or actually I hit you can hit monthly returns or share price history. But I usually do monthly returns, and then I'll hit the annual returns link right here, and that'll take me to this view. So I can see a 10-year return history of each of these funds. 10-year compound history of the funds is seen right here. So as you see, the CNS funds have the best performance over the last 10 years. And the S fund leads that. But now let's put this in a spreadsheet version and show you how I performed relative to all of the different funds, and then what even just a single % increase improvement over the C fund specifically you could have. If let's just say you're always swinging in between C fund and G fund and nothing else. Yeah, and then basically you always buy back into the C fund when its price drops a single % below its the price that you exited it at. These are the theoreticals I want to show you here. I know most of you in the group and the main group are not swing traders at all, but there are swing traders who are going to be watching this, and I do want you to better understand this. Also, there are a lot of buy and hold type investors in the group who routinely, when they see a big price drop like the one we just saw this last week, they start freaking out, and we start getting a whole bunch of people asking questions about whether they should be moving their money to the G fund. No, this could not be a terrible idea. As you see here, what this individual on this TSP particular website was doing, and what you see me doing, you're seeing a completely different tell of the way things are done and the results of those moves. If you want to lose your money, go ahead and make your move to the G fund. I guarantee you're not going to be happy with the results, because yeah, you can move to the G fund, but now the question is, are you going to move back out of the G fund when the price is still below the price that you moved into the G fund at? Because if you wait for share price to go back up, they're going to get back up above the price they were at when you exited, and now you're stuck buying fewer shares with that same money than you had previously sold. You don't want to be doing that, okay? You will, I guarantee you, not like the results of your account performance when you do that. So don't let emotions dictate the way you make your inter-fund transfer decisions. If you're going to do inter-fund transfers at all, which most of you I actually don't recommend doing, except for maybe in very rare cases, better off to just don't make the moves. You can't make a mistake if you don't make the move. If you stay 100% in stocks, like I said, that 10-year performance history, if you were 100% in C fund the entire time over the last 10 years, you would have had a 13.17% compounded average gain each year. Okay, so I'd have to actually run numbers on that to see what, like, say, if you had a $100,000 balance, what it would actually come out to at the end of that time frame. But you would more than double your money, basically. Actually, you might even triple it. Okay, so comparing though, here's my performance each year. Now these are in decimal format because you can't actually compute compounded returns by percentage. You have to use it in decimal format like that, like you see here. So just to help you understand this a little bit better, 2011 I had a plus 2.70% return. The best fund was actually the F fund that had a 7.89% return that particular year. 2012, I had a 24.48% return. So basically, just take whatever, you subtract one from each one of these, and that'll give you what the percent return is. Now, in this case, it's 1 minus this or whatever. So this would actually be a minus 8.29% return if I'm doing the numbers right. But again, in order to show a true compounded return, both in terms of total return and average annual return, you have to be in decimal format to understand this. Now, they are color coded, so you can see which one performed the strongest. And since I already told you I was going to work with the C fund, and you see actually the color of the C fund being darker green means it was the strongest performing out of the 5 main TSP funds here. So in actually just an 8-year period from 2011 to 2018, the C fund had a 236.38% increase in value over that time frame. And in terms of average compounded return, that's 13.08%, or roughly. So now, again, this is similar to what you see here, but keep in mind too, my spreadsheet table here I'm showing you on the other slide, I don't have 2019, 2009 and 2010 factored into that. I'm only looking at 2011 to 2018. But so just over that 8-year period, the C fund had a 236.38% gain. What did I have? I had a 235.87. So it's just slightly below the C fund. Now, might want to also keep in mind that I spent the last 3 months of 2018 at 100% in the S fund, and the fact that the S fund saw a larger drop at the end of 2018 during that bear market slash correction than the C fund did. And also keep in mind in 2019, the S fund has actually outperformed the C fund. So these are kind of a little bit skewed results just because of the way the end of 2018 went. Now, it remains to be seen. Well, let's just take a look at how the end of 2019 plays out later this year. But I'm basically running neck and neck with the strongest fund, even though I'm swing trading. And I had an opportunity, and I have traditionally actually outperformed all of the funds. So this is the difference between using good logic when you're making swing trade type moves, or even just scaling back risk kind of moves, versus using terrible logic when you're making decisions about whether to move in or away, toward or away from stocks. Now, when it comes to swing trading specifically, you don't have to get huge gains over the share price. You don't have to sell out of your stock funds and wait for them to drop 4 or 5% before you move back in. Okay, it doesn't take that much to outperform. If you even just even one single swing trade that results in a 1% improvement over the fund that you're trading or trying to match up against, even a single percent will give you a better overall return. As you see here, it's now the 1% increase here. Okay, as you see here, these are all just literally just these plus 1%. And the end result, actually, yeah, I think I did the math a little slightly off on there too, but it's close enough. But even then, over the course of the 8-year period, the return, you would have had a 253.9969% return on your investment over that same time frame, versus the C fund's 236.88. So again, this actually would have worked out very much in your favor. So I'll just say 100. Actually. I had to run the numbers a little bit more but anyway, you would have still had a all fund beating return by even just getting a single percent increase out of it one time per year. If you are swing trading a little bit more frequently, again, you don't need the 3, 4, 5% drops to take advantage of a good opportunity. Even if the price just drops a single percent, and let's just say even if you get 4 or 5 drops a year, and you take advantage of even just a single 1% drop every single time before you're already buying back in, guess what? You have more than 4 or 5% more shares of this with the same money to work with than you had at the beginning of each year. And this end result here gets even more skewed, more in favor of the swing trader side if you're playing it that way. Problem is 99% of all swing traders don't play that way. A lot of you guys will end up just moving your money just based on the fact that you see technical chart indicators telling you when to do this or when to do that, but you're not actually digging into the weeds with the numbers here to see what you're really getting out of that. Like I said, if you're not going to keep track of what prices you're selling out at and what prices you're buying back in at, you're not doing yourself any good. Whether or not you're using technical indicators, uh, earnings fundamentals like I use, economic data, market trends, whatever the case may be. You have to buy back in lower than you sold in order for it to be a good set of moves. If you're buying in higher, you're probably doing more harm to your account than you are good, and you don't want to be doing that. Okay, so that's all on this part. I'm going to conclude this by telling you don't move your money simply because you see stock markets trending in one direction or another. As you saw from that TSP related website, they have more than a negative 5% return in the last year and a half because of the way they are doing things. Not a good way to manage your money. You want your money to increase in value, not decrease. And as you see over that same time frame, I was more than 11% stronger return than what they had over that same time frame. This is only a year and a half period. An 11% difference in performance it can become a gigantic amount of difference over the course of a 30-year period, doing the same, making the same differences. You don't want to be making these kind of mistakes. Okay, next, know where you're moving your money toward and away from, and why you're doing it. And make sure your why is a legitimately good reason. Moving your money just because you see the stock market's falling is not the way to do it. That's how you lose money, not gain money. You don't protect your investment by locking in your losses. If you can't handle volatility, then maybe you shouldn't be 100% in stocks in the first place, and you might want to consider a somewhat more conservative profile. And you can always use the diversified distribution suggestion that I maintain in the announcement post. At the moment, it's recently it was 30% bonds, 70% stocks, but because of recent changes to stock earnings yields and bond yields, it's actually changed to 25% bonds and 75% stocks. So the 25-75 profile, you'll still get 75% of the drop that exists, that comes, but again, this is like, say the S fund, let's just say it dropped 7%, then only 75% of a 7% drop would be a 5.25% drop instead of a 7% drop. And it would actually be a little bit more muted because the G fund would also be making very minute increases in value at the same time. So the 5.25% out of every 7%, like that, would actually be more, perhaps like 5.2 or 5.15 or something. So, I mean, you won't get as strong gains going up, but at least you'll be able to better tolerate the amount of drop. The best way to handle that with drops is take our advice, stop watching your account, don't watch your balance, don't worry about it going up or down. Watch us. Are we moving our money? If not, you probably shouldn't be worrying about moving your own money. And trust me, Deb and I both probably will move our own money around if we see a need to do it. But as you see, neither of us has moved our money anywhere, and we don't plan to. We still think the economy's in good enough shape where the long term, even the 1 year direction is still upward. There's no reason to fear what's going on right now with as of today, it's U.S.-China trade relations that are concerning people. Again, this is a short-term reaction, and it's all based on speculation. If you want to play a speculative game, go trade Bitcoin. That's a speculative asset. TSP is not a speculative asset. TSP is keep your money in it, and it will grow if you don't make stupid moves with your account. Okay, our goal here is to help you not make stupid moves, or as I should also say, maybe uninformed moves, or uneducated, or help you avoid making emotional decisions that are going to harm you. Okay, so also here, if you're going to move at all, move away from stocks when stock prices are high and rising, and return to stocks after stock prices have fallen to any level below your exit price. This is only if you're going to make moves at all, particularly those of you who are swing traders, or those of you who are going to kind of play kind of a scale back or scale in risk kind of game, even if it's not necessarily swing trading. Just the fact that you're moving money from stocks to bonds or from bonds to stocks at any degree, I would just go ahead and call it swing trading. Okay, or it's not, I wouldn't really call it market timing, because a lot of you guys are just reacting to what you're seeing, and it's a very bad way to invest. Guaranteed you're not going to get good results by doing that. Okay, so take all this advice here. Don't move away from stocks just because you see stock prices and your account balance falling. Like I was saying, the sky is falling. No, it's not. This isn't. Stocks always move upward over long term, even if they go down for shorter periods, even maybe up to 6 months at a time or whatever. They still go upward long term. You can take any 20-year, 30-year period and basically compare us as let's say the stock index's value 20 or 30 years ago to the same date 20 or 30 years into the future. You won't find one single occasion where the share price 20 or 30 years into the future was actually lower than the share price originally. Okay, so it's a guarantee that share prices will go up long term. You just don't need to panic. Okay, and then like I say, if you are a little bit too averse to the volatility, and I don't want to call it risk because it's not really risk, it's volatility. Maybe you're too averse to that, or are really close to retirement and are really scared about losing your money that you're going to probably need very soon or already are needing. Education is the key here. The more you understand about how markets actually work, and more about what's going on really with the economy, and think things through, the more likely you're going to be to make smarter decisions. But again, if you don't have that knowledge, experience, wherewithal, whatever, and you can't handle these larger swings in prices that go downward as well as upward, then maybe something a little bit slightly more conservative would be a better fit for your needs. Okay, that's all I have for this presentation. I'll have more to come, of course, in the near future. Thanks.